All right, so I have some stale bread to use today. Okay, the levels I have here on the chart are from last Thursday. So last Thursday's data, last Thursday's gap information. I'm not going to bring in anything from Friday or this morning. So we're just going to study price action on the basis of that. So I want to see it trade up into this little purple box area if it can. Use that as a premium. If it runs for the sell side over here first, then I'm not interested in that. This gray box in here, that is Thursday's first presented fair value gap. So we didn't get the run back up into the bottom of that before taking out the short-term low on the 1 minute chart. Now see how coming back to it there like that, I'm not as interested in it there. As it was forming this candlestick here and left that little tiny little volume imbalance. But prior to this low over here, that low being taken, in other words, let me annotate real quick. The framework was this. I wanted to see it when it broke below it here and it created that little gap between the bodies. This candlestick, I wanted to see that close, the next one open up, trade through the volume imbalance and hit the bottom of that purple shaded area, which I'm going to show you in a little while before I close what those levels are and teach you a little bit more about the new day opening gaps. But prior to that low being hit, that's the better scenario. That's the better setup. Because it's coming back up into a premium. It's repricing to here. Then it drops down into that low right there. So that would be a very, very low resistance liquidity runs setup. It's still delivered again, but I prefer it to do it when the liquidity hasn't been taken yet. All right, same scenario here. We're looking at the top of this old inefficiency from last week. We're going to study the behavior of it around the top of that to the midpoint. We've already got real close to the midpoint of it. Let me take this line off. In your notes, okay, your setups, just because we're looking at specific levels or PD arrays, there has to be a displacement off of that level. That's the signature you're looking for. Just because we have the lines or the levels or the rectangles drawn over top of the price action, there has to be something that kind of like tips its hand, shows you, hey, look, I'm about to do it. Here's the proof of it here. And then you wait for the fair value gap or you wait for an order block to trade back to. The signature might be a run on stops before it trades to the PD array, and then wait till it's trading at the PD array and then drop hard or rally away from it based on whatever you're looking for. Right now, I'm going to pull up the regular trading hours. So we have a premium gap here. So it's already done its return into mid gap. We have all of this portion down in here between this candle's low and that candle close. This is the unfilled portion of the opening range gap. That's this right here. It's not the color I want to use, but so all of this area in here, that is all still open and primed for a potential exploration down into that. But that's the low of the day so far here. We'll go back to regular trading, electronic trading hours now. Notice that the first presented fair value gap, looks like it's really small in here. Yeah, it's only a quarter of a point. It's not all that exciting. I'd prefer to use this. in here because it's so small. Kind of like that little dick energy that's on Twitter. It overlaps with an old new day opening gap too, so we'll see what happens. If it can trade above it, then we'll watch and see if it wants to treat it as a discounted reg, but it has to show displacement off of it, not just simply trading to it. It's Monday. We have a large gap. All this price over here that was smooth, it's been made jagged, and we have unfilled portion of the opening range gap in that blue shaded area down there. So I'd like to see something create a fair value gap in here, and then it can explore down into the lower ends of that unfinished opening range gap. When it's muddy like this, meaning that it's just a lot of holding price, that's time distortion. And I like to elect to wait till 10 o'clock. So 10 o'clock starts the silver bullet. So it's a whole lot more probabilities shifting in your favor if you simply just wait. Caleb's strongest version of his model is going to be when he sees a short-term high taken here, trades down, takes out a short-term low. So it takes the buy side first, then takes the sell side, then rallies, uses a fair value gap, can be inversion or it could be, wow, look at that, see that? There's a big flurry. The sell side below here, using a consequent correction of that wick, that's what I was using for the entry. I missed the opportunity to go in below here. I wanted to capture that, but I wasn't able to pull it off. Just pushing the button. If I would use a limit order, I could have got it, but it's not likely to always do that for you. So there's my entry, just a little bit above the consequent encroachment, and then the inversion fair value gap, as I mentioned in annotations, and rallying for the short-term buy side. And then I used the load high 0.25 extension, and then because they don't always get traded to, I finessed the exit with factoring in the spread. And this is what I'm talking about when I'm teaching that you want to capture the move. You don't need to capture the highest high. You don't need to capture the lowest low. This one here ideally should act as an inversion. I don't want to enter in it. I want to see it go away from it and come back and touch it. And I like to see that stay open right there. Oh, they filled that. Okay, it's fine. Then it definitely has to come down below it and then tag it again. Notice that it is not an entry yet. And what I'm looking for, it hasn't been offering it to get in, which keeps you from doing what? Taking losses. A buy side right here. I believe we might be looking for 2251 and a quarter. That would be up here. That's the August 22nd, 2024 buy side liquidity. It's an old daily high. So it looks like we have priced in a potential framework for that run there. Now these are problematic areas for me because I don't like to just use this little inefficiency here to try to capture that, because to me, it could still come back down and trade into this inefficiency or retouch the first fair value gap that's presented. So I have to sit on my hands and wait until 10 o'clock and use the first fair value gap there for a silver bullet. See what I mean? So it's this is a very, very dirty market this morning. Just so you know, I'm going to force myself to take a trade just to prove it, but I'm going to try my best to do it my best using what's in the market right now. But right now, I would not be wanting to trade this morning, but I'll force it in there just to show you. Is if I trade in conditions I already know that it's not conducive for me, it's good for you guys to see me do it wrong. All right, so they took buy side and we're way back down into the first presented fair value gap. So what you would want to see is here, we want to see it displaced to the upside. If it's going to go to that higher time frame daily buy side, it may not be going there today, but we want to see the initial attempt to do so because we have relative equal highs in here. I'm watching this one. I was going to use this one originally. That's how I was setting up the low limit order, but I was like, nah, that looks like it wants to come back down in there and touch that again. If it was 10 o'clock and as it traded there, I would have had no problem, no apprehension whatsoever to get in there and go long on that one and have a run to these highs. It still might do it, even though we're not in 10 o'clock yet. That's unfortunate if it does, because that's kind of like what I'm wanting to frame it on based on time too. Now see how it has all these wicks in here? That's what makes it a dirty read. It's real hard to get precision in that because you have multiple wicks here, and they're not right next to each other. So I can't do a gray pull in here. It's very, very challenging this morning. Let's put it that way. Because while I do like the fact that we didn't go any deeper on the opening range gap, and then we've now cleared the highs, and we're holding it there. We're consolidating around that high. So that could be accumulation for it to run higher. Longer term, I see this up here. So if you don't have that on your charts, just take a look at it on your daily chart and you'll see what that level is. It's based on the daily chart. But trying to get in all of this messy price action, it's just waiting. So since it's waiting, I'm going to wait. I don't need to get the lowest low or the highest high, depending on what direction I want to move on. I've already seen enough. Every time I've seen the setups, I see reasons why that's not good. And while I don't mind taking a loss in front of you, I'm not trying to take a loss just for the sake of taking a loss. I'm not trolling today. So far, the run off of the flash manufacturing PMI number that came out, which I don't ever look at the data, but that's what created this little flurry in here. See if we can come up and touch the first presented fair value gap again. See if it'll treat it as inversion. Watch the body. You see how like demanding that it gives you displacement after it trades to the PD array. It keeps you from getting in the trade. The afternoon session should be really nice then, because this is being held a lot this morning. I'm watching the 1 minute candle over here. I like to see that candle stay kind of right where it's at with its low. The next candle trade down below that low there, and that would be potentially a silver bullet for a run on the buy side. We have price coming down to past mid gap, where consequent encroachment of the opening range gap. Again, that is seen here. That's this gap here. So we filled half of it, a little bit more than that. Broke to the upside. We had a nice low. It jammed through that. So it's been made jagged in here. Price action will be cleaner in the afternoon because of all of this holding price. Once it finally is allowed to release and go the direction it's going to go in, it'll be a lot more sustainable in the afternoon. I was watching this one. I want to see if it could go down and leave the upper portion only traded to and the lower portion not traded to. And that stop would have been right underneath that candlestick's low. So that would have been a stop out too. So far I'm very pleased I'm sitting still so far. I got plenty of time still before 10:30. If it gives me a setup, I can take it. Volume of bounce sitting right on top of the 1 minute fair value gap. That's this one over here. So everything I'm annotating on that 1 minute chart to the left, it's being transposed over here on the 15-second chart. There's a small little volume imbalance right there between these two candlesticks bodies, and it would touch the top of that 1 minute fair value gap as well. So I want to see it show some respect off of that and displace higher, and then that would give more confidence that it's going to want to run above these highs here. These lines here are denoting that should we trade above it again, these should act the same thing as a rectangle that's over top of a fair value gap when it's inverted. So I'd like to see it. If it can get above it, treat that as discount array and then press higher. I just don't want to have another rectangle in the chart because there's already a lot of stuff on here. As soon as you can recognize when the market is being held, the better your trading is going to be. And any given day, it could start off looking like it's going to be a wonderfully technical day, but then it goes right into holding patterns. And it's just, you can pick up on why I'm not trying to push the button is because I know I'm in this condition. And the way I recognized it was we're spending too much time inside of inefficiencies or gaps. They should never spend time inside them. Like, see how much time it's spending in here? That's not what you want. You want to see that when it's above old highs because that's accumulating new longs. You want to see that when it's below old lows because it's accumulating new shorts. But you don't want to see it inside of inefficiencies because if it shows that, that means that it's being held or strangled. And that's simply just time distortion. That means the market is not being permitted to see the price runs yet. It'll be there. It's coming, but trading ahead of it, you're going to get beat up. They were nice enough to let you see that high stay intact, so you know it's above there. I'm not sure what I ate, but man alive, my stomach is hurting. There we go. And then we have sell side. Now, right away, you can probably appreciate that you don't know what I'm actually writing down on the notepad next to me. I understand that. But I've mentioned that most of what I'm showing you in the chart, level-wise, is most likely the majority of what I have on my notes. Maybe we'll go down into that opening range gap a little deeper, and in the afternoon come up for that buy side. So far, she's been good. I want to see how it reacts off of the first fair value gap of the morning, which you see it over here on the 1 minute chart. That first presented fair value gap is 932. Now, one of the things I like to do on days where I'm a little apprehensive, this would be a trade that I would enter on if I was confident that we were directionally poised to go lower. I'm not convinced of that yet, so that's why I highlighted it in gray. And I'm watching, does that trade pan out? And then now it's hitting the first presented fair value gap of the morning. And I weigh out how comfortable would I be still in that trade based on what we're seeing right here. Because all of that range from where we are right now at market to here, that's the range that's afforded still. Watch that wick right here. And watch this one. So I don't like the fact that we had another attempt to get back up in here because we already hit consequent encroachment of the first fair I got for today, and we hit it again. I don't like that. It should have hit it once and then left it, not spent any more time. Remember, you don't want to see price staying inside of the inefficiencies. Any gap, any inefficiency, any wick, those are inefficiencies. You do not want to see price staying inside of them. See what I mean? Now, the way it's delivered here, I'd want to see it go higher now. So consequent encroachment should not be violated on that. It should be staying above it. So that midpoint there. It can trade down into the upper half, touch the consequent encroachment. It can wick through it, but it's better if it keeps that lower portion open. Watch this wick. See it? Lower half. Keep your eye on that. Now look at the 1 minute over here. you see anything in here? Let's do this. New drawings. Look at that price action. Tell me, do you feel that that's a high probability trading scenario? Are these conditions that are high probability? No. So it's not surprising, even in my own hands, that I'm not able to see very clear because it's being held here. But I'm trying my best to find one where I'm willing to throw the dice on it just to show you, even if I trade in these conditions. If I trade in these conditions, I will lose. And that's not a derogatory statement about my ability to trade. It wouldn't be a derogatory statement about anyone at all trading in this environment. But you have to recognize it. You have to understand what these characteristics look like. All right, so we ran for the buy side. Now where we're at right here, because we've cleared the initial high today over here, this would need to start showing some interest going higher. Otherwise, this could soup and come down all the way and clear up some of the sell side that's here. Because anyone that's been long and they're holding right now, if they're smart, they wouldn't be trying to strangle the price because it's been real spotty in the way it's been delivering. So they would want to keep their stop loss a little bit further back, and they'd be resting right below these relative equal lows. So we're at a juncture right now. Well, it would need to start really running higher if it's bullish. That's what I would expect. If I was long where I was getting ready to do the entry here, I would not want to see what it's doing right here. Like I want to see it now be moving higher. Over here on the 1 minute chart, we're inside that fair value gap there, and it's consequent encroachment of that wick. So there you go. No, knowing why you shouldn't is so much better than just simply giving me an entry strategy. If I'm in front of the charts and it's not giving me something that's very sound, very easy to get into, and the logic of where the stop loss needs to be, and it's no reason for it to even reach there unless I'm absolutely wrong. I don't have that right here. It's basically what I'm getting at. I can see the setups. I can see them. I mean, I pointed out to two of them. We looked at this one here. There, I framed it. That used to be a gray shaded area, and it traded down, but then it failed. And I told you it's likely to fail because it's spending too much time, and it went back up here on that candlestick the second time to consequent encroachment. You don't want to see that. You never want to see that. If it can get that deep to get to consequent encroachment and it leaves it, that upper half should never be traded to, and that consequent encroachment should not be traded to until it takes that low out. You need to record that in your journal because that's real important, because that's a repeating phenomenon. That could be a model in and of itself. You don't need much, folks. The one in here, I was going to take that one for the run into the buy side. It would have yielded 15 handles or so, but I didn't like it, and I'm thankful that I didn't do it because that stop would have been right there. And when it was above it here, remember I was telling you, it had already spent too much time there. It's already spent enough time for it to then want to rally if it's going to go higher. And what did it do? So a very, very challenging market. All right, we're at that junction again. Either it wants to run higher and make a higher high, and if it does, that would be bullish. Or if it fails here and rolls over and goes for the sell side. Because it can be both right now. Is that high probability based on what I teach? Nope.